LLC, S Corp, partnerships. Which entity structure should I choose? Let's talk about it. Now, before we talk about entity structures, first I want you to know you should talk to a competent attorney and tax professional in your state or the states that you are doing business, because it is important to follow the rules and the laws within your specific state to get the maximum benefit of that entity structure, whether it's doing business in the state or reducing your taxes. Now that we've talked about that, how do we choose the entity structure? Well, there's a couple of questions you need to answer before you make that decision. Are you trying to raise a significant amount of money for your business? Maybe you're going to have foreign investors that invest in your business. Or is this a side hustle that you're starting to see if you can just make a little money on the side? Or maybe you and a friend have a business idea and you've gotten together and you want to launch this business and see how far it can go. Those are all important questions that need to be answered before you select your entity structure. Now, one of the benefits of entity structures like LLCs and corporations is limited liability protection. What is limited liability protection? Let's kind of talk about it. Let's talk about it from a historical perspective. First, limited liability started as early as the 1700s with the Dutch East India companies. They formed what were called joint stock companies. And the reason they formed these joint stock companies was to spread out their liability, to limit the liability of their investment in that particular venture. But as early as the 1800s, England and the United States, they started drafting and codifying into law this concept of limited liability. Limited liability was you had a group of investors that were together and they wanted to limit their losses, and they would spread those losses out because they would have multiple people that would put money into the pot. By the mid to 1900s, businesses started forming corporations because in the United States, limited liability was being codified into law. Then in the 1970s, the LLC came along. Now, the LLC got started by a company called the Hamilton Brothers Oil Company. They went to Alaska, and what they were trying to do was mimic some of the limited liability and tax protections that they received in Panama. Alaska wouldn't pass it, but Wyoming in 1977, they were the first state to pass legislation related to limited liabilities. And so Wyoming is the birthplace in the United States of the limited liability company, and we haven't looked back since then. So, okay, that's the history, but what exactly is limited liability? Let me give you one example. So I had a client and she used to sell temporary tattoos. And let's say that client, one of her clients, customers, a daycare center, they order a batch of temporary tattoos, and they're going to use these temporary tattoos for a party that they're having for all the kids and the parents, that attended the daycare center. So these little kids, they're putting these temporary tattoos all over their faces and their arm, and everybody's laughing and they're having a great time. And they've got all these temporary tattoos all over their bodies. Everybody's having a great time. However, little do they know, the ink is not temporary. It's toxic, permanent ink. And so the mothers and the parents are frantically trying to wash this ink off of their faces and bodies, and the ink isn't coming off. It's not rubbing off. You and I know what's going to happen. Everybody's getting sued, especially my client. What limited liability protection would do is it would limit the damage if the company lost the lawsuit from all the parents that sued the business for this permanent ink that they can't get off their face. And so technically, again, this is for educational purposes. Technically, the only losses to that company, the company that sold the temporary tattoos, is whatever is inside the bank accounts and the value of that specific company. So if it's $10,000, theoretically, that's all that you're going to get. That's all that the parents are going to get is the $10,000. That's limited liability. And so that's one of the purposes and benefits of having a separate and distinct entity from yourself. Limited liability. That's one of the reasons why we have LLCs. Now, each state is going to dictate how an entity is formed, whatever that entity is, whether that's an LLC, a PLLC, a PC, a corporation, an LP, an LLP, a GP, whatever these entities are, however you do business in that state, each state is going to have regulations and statutes as to how you form these entities that make you separate and distinct from its owners. That's why you see things like Wyoming LLCs being marketed, Nevada corporations, Delaware LLCs, or Delaware corporations. These entities are marketed because in those states, sometimes they have more lenient rules for businesses that may be more advantageous for the business. And so these entity structures, yes, there are tax benefits, but one of the other benefits, one of the primary reasons they're put together are for all of these other reasons. So just getting an LLC doesn't give you any specific tax benefit. There's certain things that have to be in place for you to get the tax benefit. Okay, so let's talk about taxes. What type of entity structure should we have in order to mitigate taxes? We have to talk about the taxes at the federal level, because again, the states will form multiple types of LLCs, and the rules in each state may be different for those LLCs or those for-profit corporations or those PLLCs or those PCs or all the other LPs, alphabet numbers that are created, alphabet letters that are created for those specific entities. So, but at the federal level, we only have a handful of entities. That would be sole proprietorships, partnerships, and corporations. And there are different types of corporations, S and C, and we'll talk about those. Okay, so when should I choose what for tax purposes? Well, a sole proprietorship is when you have one person starting a business. And generally, I recommend a sole proprietorship when it's that side hustle that you're starting. You say, I want to start a business and I want to see how far I can go. I really don't recommend you setting up an LLC for that. I recommend you just having a sole proprietorship. And in most states, there's not really a lot of paperwork you need to fill out for the sole proprietorship. Now, a partnership is just two individuals that come together. There's not really a lot of formality around that. However, I highly recommend, you need to set up a partnership agreement anytime two people come together to do business together for a profit motive. So if you and a buddy start a business, why everybody loves each other and you're going to make $1 million, but you haven't made a dime, that's when you need to get a lawyer, draft a partnership agreement, but we can have an entire video talking about that. Well, what about the S in the C corporation? Well, an S corporation gets its name from the subchapter S of the Internal Revenue Code. That is a chapter that regulates the rules around how S corps are taxed. And the benefit of an S corporation is it will help you, one of the benefits, it will help you to reduce self-employment tax. That's one of the big benefits. For a S corporation, you're going to complete what's called an 1120S. So that business will have its own separate and distinct tax return. And then each owner of the S corp, each shareholder is what the owners are called, they're going to get what's called a Schedule K1. Partnerships are the same. They have their own separate and distinct tax return. That tax return is going to be a Form 1065. And each partner in the partnership is going to get a Schedule K1. And those Schedule K1s from the S and the partnership, they'll be used on your personal tax return to prepare your personal tax return. A sole proprietorship doesn't have a separate tax return, but what it does have is a separate schedule. It's called a Schedule C. and you prepare that Schedule C for your sole proprietorship business with your personal tax return. So unlike a partnership and an S Corp and the C Corp we're going to talk about later, the sole proprietorship doesn't have its own separate tax return. Now, the C Corporation, like the S, gets its name from the part of the Internal Revenue Code, subchapter C, that regulates the rules around a C Corp. A C Corporation is used when you want to raise a significant amount of money and you want a wide variety of investors. You want the availability of a wide variety of investors to invest in your business. That business will have its own tax return, the C Corp. That's called an 1120. And there are times when having a C Corp will save you more money than an S Corp. But there are specific circumstances when that is the case. As I mentioned before, what you always want to do with any of these entity structures that you are considering is talk to competent legal and tax professionals before you start the venture. Don't go out and start, a venture and then elect all these things and then come back and try to have someone fix it. I see people every day, prospective clients that come to me and they formed an entity a certain way, didn't understand the ramifications of it, and they put themselves in a worse position than a better position because they didn't reach out and get competent legal and tax advice. So again, which one of these should I choose? If you're a sole proprietorship, I don't think you should file for an LLC. And where's the revenue or income number we should be looking at? If your net income is anywhere between $20,000 and $30,000, whether you're a sole proprietorship or a partnership, that's the time you want to think about forming an LLC. Your income is going up and this is a viable business. Then it might be time for you to form an LLC. Well, when should we pick the S Corp? Well, the S Corp you want to pick when you have about $40,000 in net income. I want to be clear on this number, net income versus gross income. Let's take a second to talk about it. So gross income is all the money that you bring in from all of your sales. Your net income is the money that's left over after you've paid all of the business expenses for buying your product, selling your product, all of your overhead. After you've paid everything, that's your net income. And so when your net income is around $20,000 to $30,000 and you have a viable business, that may be the time for you to set up an LLC. If your business is making $40,000 or more and you are fairly confident that your income is going to be increasing year over year, that's the time you want to be an S Corp. A C Corp, like I mentioned before, that's best when you're raising a significant amount of money or you're in a specific tax situation with your business where it is more advantageous to pay a corporate tax rate than it is to pay the personal tax rate. But again, for that type of analysis, you want to talk to a tax professional. Now, one of the benefits of an LLC is flexibility. If you are the only owner of an LLC, that's called a single member LLC. And again, the LLC is a state level entity. So when it's time to file your taxes, the federal government is going to disregard that state level entity, and they're going to treat you like whatever is behind that entity. So if you have an LLC and you're the only owner, then you're a sole proprietorship for tax purposes. If you have two owners and you have an LLC, well, the IRS is going to disregard that LLC and say, well, what do I have left? Well, I have two people there. Well, that's a partnership. And then with the LLC, because you have an entity, you can elect to be taxed as an S or to be taxed as a C. So you have flexibility with the LLC. And that's why it's a, often touted entity structure because of its flexibility. Now, a lot of people say, hey, if you have an LLC, you don't really have to do anything. That's not true. There are still things you need to do, and that is dictated from state to state for that LLC to be treated like a business. Now, for-profit corporations, if there's one or two members, they're still for-profit corporations. They're taxed as a corporation, but you may elect to be taxed as a C or an S for your for-profit corporation. And again, that's a specific entity structure that's different than the LLC. So there you are. We've talked about the different entity structures, when and how you should choose them. Again, this is just basic information. Just like all of the information you see on YouTube, take the information in, go back to your favorite and a competent tax and legal professional. Ask them, hey, I found this on YouTube. Give me the pros and cons, the in and out. I want the complete picture. And that's how you're going to know which entity structure to choose and give you the best result. See you next time.